Later CPA and Associates, accounting them grapevine mates.
Hi there, I'm Daniel Later, founder of Later CPA and Associates, and welcome back to our ongoing series, Tax Strategy, right here, right now, where we are talking about great ways to reduce your tax bill and skipping all the jargon. This week, we're going to be talking about startup cost optimization, especially for new practices, a way to launch with more tax deductions. So starting a new practice costs money fast. So the good news is that some of those launch costs can help to lower your taxes. The bad news is that not every cost is deducted the same way. So our goal here today is I want to show you how startup costs work, what gets deducted right away, what gets spread out over time, and how to make better decisions before your practice opens. So why does this matter? Well, many new practice owners spend money before they officially open. That's normal. And they assume it all gets written off right away. But the IRS treats many pre-opening costs as startup or organizational costs, which usually means special rules can apply. So if you are tracking these costs right away from day one, you can avoid missing out on deductions later. Now, what are startup costs? Well, startup costs are the expenses that you pay before the business actually begins operating. Now, the IRS says that these can include things like advertising, travel, surveys, training, and a startup cost generally works as if it is the kind of expense that would be deductible in an existing business, but it was paid before the business officially began. Now, what are organizational costs? Organizational costs are different than startup costs. These are costs that you have to legally set up the business entity, such as forming a corporation or a partnership. Now, here's the thing. The IRS will separately allow up to $5,000 for startup costs and up to $5,000 for organizational costs. But each of these starts to phase out or get reduced once those categories go above $50,000. So what happens to that first $5,000 in each of those categories? Well, any amount that is not deducted right away within that $5,000 can get amortized or spread out over 180 months. That's 15 years. Now that 180-month period starts the month the business begins operating. So it's a timing issue. You might still get the deduction, but not all at once. So here's some of the mistakes to avoid. First, remember, buying equipment is not the same as a startup cost. If you have to buy furniture, computers, equipment, these are usually recovered through depreciation. That's a totally different thing from startup or organizational costs. That means that you need to separate your pre-opening expenses into the right buckets instead of putting everything into one pile. Now, how do we optimize that? Well, you track your costs by category from the start and keep startup costs, organizational costs, and equipment purchases separate. Now, this can be as easy as starting your bookkeeping system early or having a simple spreadsheet to track these things. That makes it much easier later on. Good tracking of these expenses will help you know what may be deducted now and what must be spread out over time. Now, when does your business actually begin? Now, this is important. Timing matters because startup costs are costs that are created and incurred before the business begins. And the amortization period starts when the business begins. So, what is the actual opening start date? Good question. It's when the business starts acting like a business. Think of a store that sells fruits and vegetables. The first day it opens its doors, that's its opening day. If you think of an online business, think of the first day it starts accepting or reaching out or scheduling new clients or potential clients, when the business actually starts reaching out to perform business activities. That's opening day. Now, another thing, don't mix up your startup costs with your operating costs. Keep them separate. They both have their own $5,000 bucket. And for most private practices opening up, if you keep these separate, your organization costs and your startup costs, you're going to be well under the $5,000 level. So that means you can basically deduct all of these things the moment your business starts operating. If you go above $5,000, again, we may need to amortize those things over 180 months. So keep that in mind. Keep the costs separated so we don't double count them in the same category. And again, remember, there's some expenses or costs that don't fall into organization or startup costs. Your furniture, your computers, your equipment, those are treated separately as depreciable. So let's look at a couple practical examples for a new therapy practice. Your website launch and pre-opening ads, those could be startup costs if you've paid it before opening. Your state filing fees to form the entity may be an organizational cost, depending on the type and the date. The laptop, the desk, the furniture, not a startup cost. That's depreciation, and that's different. We'll talk about that another time, but that's different. Don't add it to your $5,000 buckets. Your tax result depends heavily on keeping clean records and proper classification. So a couple closing thoughts. When you launch a practice, tax planning should start before the first client walks in. The goal is to not just spend money and hope it becomes a deduction. The goal is to classify costs correctly, time them well, and build your records so your new practice starts clean and you don't miss deductions. Critical thinking question for you. Are you tracking your launch costs in a way that clearly separates the startup costs, organizational costs, and equipment purchases? Or are you just making tax season harder for yourself than it needs to be? So next week, we are going to talk about accelerated depreciation for equipment and offices. So don't forget to like, follow, and subscribe for future events and tax advice. Visit our website, latercpa.com. Have a great weekend. Keep helping others to help themselves, and let us help you to do just that. I'll see you next time. Bye.